Jared Newton here, and today we're talking about the VA funding fee. What is it? How can you avoid it, or how can you at least mitigate it? So the VA funding fee is in essence a mortgage insurance premium. I know it's not called mortgage insurance, and a lot of lenders will advertise no mortgage insurance on a VA loan, but that's really what it is in effect. They call this a funding fee, but by any other name, it's mortgage insurance premium. So if you have any service-connected disability rating at all, you can just go ahead and skip this video, go to the next one, because you are exempt from all funding fees every single time. For all the other service members out there, either active or veterans, you will have a funding fee on every VA transaction that you incur. So how is that calculated? It depends on a couple of different things. One big one is, have you ever used your VA entitlement before? So you get a little bit of a discount if this is your first time. Another one is, how much of a down payment are you making? There's actually a substantial benefit for you to put down 5% on a VA purchase, even though you don't have to. So for, let's say, especially if it's subsequent use. So a subsequent use, 100% financing VA loan, you're going to pay 3.3% as a funding fee. Now, you don't have to pay it out of pocket. Funding fees are always put on top of the mortgage loan amount, but you're still going to pay it eventually. So, but if you put down 5%, just 5%, that goes from 3.3% to 1.5%. So you're immediately getting a 1.8% return for a 5% investment, although really you're not investing because you're owing less. It's not like a cost you're incurring. You're just not having that much debt, and you get this 1.8% discount. That's a huge return. In addition to that, the VA offers what's called interest rate reduction refinance loans. They're called IRRRLs, or simply VA Streamlines. So for an IRRRL, every transaction on an IRRRL is 0.5% funding fee. So a technique we use sometimes, especially in environments where interest rates are getting lower. Now, that doesn't so much apply today, but in an interest rate decreasing environment, what you want to do is mitigate how much of that funding fee you have to pay for that purchase. So for example, what you can do is you can purchase that VA home, elect to take an interest rate that is higher than that par average rate, and in exchange for that, you can have your lender pay all or a substantial portion of your funding fee. Then, 6 months down the road, you can get your interest rate reduction refinance loan and only pay 0.5% of a funding fee. It's substantial savings, especially when you look at larger loan amounts. In addition to that, you can do a 100% cash out, debt consolidation, home improvement refinance, where you can get 100% of your property value with a little bit of an asterisk on there. It's subject to your entitlement amount and county limits, which varies dramatically. I have a whole video on that. But that cash would be yours no matter what. The funding fee in all of those scenarios, though, whether you have equity or not, is going to be 3.3%. So that's another scenario where we look at potentially doing a two-step approach, where your lender pays the funding fee for the first go around, and then 6 months later, you do your IRRRL, and then you only pay 0.5%. You'll save thousands and thousands of dollars, especially with the higher loan amounts. Thanks so much for watching. If you have any VA scenario that you're looking at, or you have questions about what you can do with your existing VA or prospective VA, give me a call. Thanks so much. Bye.